Hi everyone, it's David from Aventine here, and welcome to another quarterly presentation where we take a look back at what happened over the last year and provide you with some insights into how we're set up for the year ahead. We named this presentation KISS as we truly believe that in 2023 it is essential to keep things simple, to focus on valuations and asset allocation, and ignore the headlines. With the central bank rate hiking cycle nearing its conclusion and the market's view of inflation much more reasonable and accurate than it was last year, it is essential to begin to deploy more capital to get set up for the next bull run in risk assets. Before we look ahead though, let's take a quick look back at the last year. Here we have a scatter chart showing the performance of a traditional investment portfolio of stocks and bonds represented by the S&P 500 and the Bloomberg Bond Index. As we can see, 2022 was a significant outlier. While there were some years in the data set where the equity market performed worse, the bond market had by far its worst year. Let's take a look at the returns on a more granular level. Here we can see some more details. Clearly, in the equity market, the energy sector was the standout, with a return of 65%. But what's also remarkable is how little dispersion in the negative returns there was in the bond market. When you buy a bond, you gain exposure to three types of risk. First, duration or interest rate risk. Second, credit risk. And third, refinancing risk. Since investment-grade bonds actually performed worse than high-yield bonds, we can infer that the issues in the bond market are nearly entirely explained by the change in interest rates. Investment-grade bonds tend to have a longer term than their high-yield equivalents, which means that their prices tend to be more exposed to the changes in the yield curve. Also, it tells you that the bond market right now isn't that concerned about credit risk or solvency, which points to the fact that companies generally have solid balance sheets. Speaking of the yield curve, here we can see the tremendous difference in the shape of the curve over 1 year. In December of 2021, the yield curve was upward sloping and fairly normal. Fast forward to today, we see the yield curve remains significantly inverted, with peak yields at the 3 and 6 month maturities. Now, using the yield curve, we can infer what the market thinks that Federal Reserve policy rates will do in the future. As you can see, the market does not believe that the Fed will make it to 5%. In fact, the market predicts that the Fed will be forced to cut rates by 70 basis points beginning in the second half of 2023 once inflation begins to come down significantly and the economy begins to show signs of stress. Interestingly, some people don't even think we need central banks to determine interest rate policy because all they really do is follow short-term yields, which are set by the market. Here, we can see how closely interest rate policy follows the US government 2-year yield. Anytime the 2-year yield decouples from interest rate policy in any meaningful way, central banks tend to adjust policy to match. That's why internally we say if you want to know what central banks are going to do, look at the 2-year. Right now we can see that the 2-year yield is below the upper bound of the Federal Reserve rate. So the market is saying that Fed policy is too restrictive and needs to come down. One of the most compelling arguments for the Fed cutting rates doesn't come from the potential of a hard landing or recession, but actually from the sheer size of the interest bill the US government is facing should they keep rates where they are for an extended period of time. Here, we can see that the forecast of US annual interest payments could reach $1 trillion if the US budget deficit grows by $1 trillion and rates stay at 4%. Those are reasonable assumptions, and that looks unsustainable. Now, in Canada, we don't have the same level of indebtedness at the government level, but we do have significant housing market exposure at the individual level, and that is a huge domestic risk. As we can see, the estimated monthly payment for the average Canadian household has doubled since 2010, leading many to predict a significant housing market correction if interest rates remain elevated for a long period of time. Perhaps the most compelling argument for how the market can avoid a recession is that unemployment remains so low. We believe that this is one of the most important charts today. It is essential to monitor employment figures for any sense of a breakdown. As we can see, when unemployment ticks up meaningfully and crosses through its 12-month moving average, it is nearly always followed by a recession. We think that unemployment can stay around these levels due to the fact that much of the labor market tightness was caused by a significant amount of job openings, which can be unwound without too much economic damage. Even if we avoid a recession, we believe bonds are extremely attractive here. This is because the attractiveness of bonds has moved from their diversification benefits to their yields and income generating abilities. 2022 began with bonds being extremely overvalued, but that has reversed quite dramatically. In fact, if we look at bond yields compared to the equity market earnings yield, we can see that the ratio is between 2 and 3 standard deviations away from the mean. In order to bring this ratio back in line, we would either need to see a significantly lower equity market, much lower interest rates, or some combination of the two. The key to both of these is inflation. Headline CPI was range-bound between 0 and 2% before reaching a peak of 9% in 2022. Now, the market-implied inflation expectations are predicting that CPI will drop consistently, but then remain at 2% in the future. This seems a bit silly to us as inflation almost always overshoots in both directions. It seems unlikely that inflation would just stop at 2%, and we may be in for a period of deflation in the coming months. The relationship between CPI and M2, or money supply growth, is well established. Today, we have the lowest money supply growth in 50 years, and in fact, this measure has just gone negative. If we look at history as a guide, inflation continues to fall for several years after the money supply growth has bottomed out. All of this can be seen in the savings rate, which has fallen steadily, dropping to 2.2% in October from more than 7% a year earlier and marking the lowest level since 2005. The decline perfectly matches the drop in the broader measure of M2. These patterns in the data also suggest lower income and middle class Americans are holding off on major purchases to avoid having the high interest payments cut into their checking account balances. And all of this is having an impact on prices. While skyrocketing food and energy prices were making headlines, the surge in shipping costs seemed to pass largely under the radar despite its potential inflationary impact. Given the actual increase in global shipping costs during 2021, we estimate that the impact on inflation in 2022 was more than 2 percentage points, a huge impact which is now being unwound. Now, when we look at inflation, it is important to distinguish between the cyclical and the structural. Cyclical inflation is rather easy to control by tightening and loosening financial conditions, but structural inflation is notoriously hard to get rid of. The fall in inflation this year is being driven by a decline in cyclical inflation. Structural inflation, now the highest it's been since the 1970s, will fall too but remain much stickier. A tangible interpretation of this is that as goods inflation, which is more cyclical, falls, the extra income goes into services inflation, which is more structural. Anyone who has recently purchased a plane ticket has probably noted that it doesn't appear to be getting cheaper. While house prices and the cost of living are generally slow to react to financial conditions, we are beginning to see this come down as well. If rents and home prices continue their descent, it's only a matter of time before the shelter CPI turns down. When that happens, given the huge weighting of shelter CPI in the overall index, approximately 33%, we could see the inflation rate really turn lower. Outside of housing, we're seeing continued price improvement in other areas. Gas utilities were up 19% year over year in the December CPI report, but the real-time data suggests this is likely to move sharply lower. Natural gas futures are at the lowest level since June 2021, down nearly 70% from their peak last August. Food inflation remains stubbornly high in the latest CPI report, up nearly 12% year on year, but the recent downturn in fertilizer prices is promising, suggesting an improvement over the coming months. A major concern of both market participants and governments alike is the potential for a wage price spiral caused by the tight labor market, which would keep inflation high. Yet, U.S. wage growth normally follows the quit rate, which is a proxy for how many people are changing jobs. As we can see, as job openings come down, so does the quit rate, and wage growth should follow suit. A byproduct of inflation coming down and a very positive market indicator is that real yields have stabilized and have stopped going up. Risk assets tend to perform negatively in the face of rising real yields. As a result, this is one major headwind which doesn't appear to exist this year in the same capacity that it did last year. Here we take a look at corporate bond spreads. As we mentioned earlier, the market seems unconcerned about credit risk or issuers' capacity and willingness to repay debt. This is a bullish signal for the equity market as we approach the terminal level of interest rate increases. The risk of a recession would be much greater if corporate bond spreads were wider than they are today. Market commentators have spent the past year making historical comparisons of today to the high inflation era of the 1970s, and have suggested that getting inflation back to 2% will be more difficult than many anticipate. However, a different pandemic parallel exists, the 1918 Spanish flu. That outbreak sparked an initial wave of higher prices, but morphed rapidly into a deflationary bust as authorities overcorrected in their attempt to tame inflation and tamp down demand. If this is the case, the time for gaining more exposure is now. Looking ahead, we are conscious that the yield curve is still inverted and that the bond market, often called the smart money, is adamant that a recession is coming. When looking at the 2s-10s curve, the yield curve is the most inverted since the 1980s and has remained that way for several quarters. However, this metric has famously predicted 10 out of the last 5 recessions, so it's far from a perfect indicator. Now, one thing to watch is when the yield curve begins to steepen again. The 3-month 10-year curve is also steeply inverted currently. As we can see, this inversion has led to recessions previously. However, typically, before a recession would begin, we would see a re-steepening of the curve so that the 10-year bonds yield more than the 3-month Treasury equivalent, which are currently anchored near the base rate that the Fed sets. However, should the economy fall into recession, it appears that this could be the most anticipated recession of all time. Professional forecasters think that there's a near 50% probability of a recession in the next 12 months. As we know, recessions tend not to happen when they are this widely expected and therefore priced in. To show how expectations have rebased, we can look at earnings results. Analysts have been proactive in cutting earnings estimates for the entire second half of last year. The result of front-running earnings results like this is that on average, 71% of the S&P 500 stocks who have reported so far this year have beaten estimates. Market pundits love to discuss that earnings estimates will need to come down further in 2023. As we know, the market often front-runs economic and fundamental data. There is empirical evidence that show that stocks often rally as earnings are coming down and approaching their inflection points. It is also important to judge market sentiment and positioning when looking at capital allocation decisions. Bank of America's so-called sell-side indicator, which aggregates Wall Street strategists' asset allocation views, fell 33 basis points in December and is now 1.5 percentage points away from the level that has historically tied to a good buying opportunity. At the current level, the indicator is closest it's been to signaling a buy since 2017. Generally, we believe the recession fears we are currently facing in 2023 look to be far less threatening and more priced in than the inflation fears that surprised the markets in 2022. To be clear, we are not advocating a transition to full risk on. However, we believe a selective reallocation through the deployment of cash over the course of the year is the appropriate approach. As the chart shows, the risk of not being invested when the market turns is far too expensive. Now let's put it all together and review. The market is coming off one of the worst years on record, especially for bonds. The yield curve remains inverted and implying several rate cuts, which is supported by the increasing service cost of outstanding government debt. However, unemployment remains extremely low and may remain that way as wage growth and job openings slow without the need for mass layoffs. Inflation is coming down steadily, which should continue through 2023 as we lap strong comparison numbers. Many market participants are expecting the economy to enter a recession this year. Yet earnings estimates have been decreasing for the last 6 months and are now at reasonable levels. There is empirical evidence to suggest that the market front-runs economic and fundamental data and can rebound as the data approaches its inflection point. This year, we want to focus on fundamentals and build your portfolio for the next leg of growth as inflation and central bank action are more predictable. At Aventine, we believe that active management will be essential for success in 2023. We are increasing our exposure to bonds and bond-like equities as interest rates reach their terminal level. We believe it is still too early to gain exposure to large-cap tech as the sector remains vulnerable and over-owned. Alternative asset classes will continue to play an important role in diversification, especially considering their positive relative performance last year. I want to thank all of you for listening and for your continued support, and please don't hesitate to reach out to any of us if you have any questions. Thanks again.